Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamilton here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
All right, Steve, let's kick things off with a significant topic that's been making waves: Canada's housing affordability. It seems there's a call for a massive increase in housing construction to regain the affordability levels we saw back in 2019. The Canada Mortgage and Housing Corporation, or CMHC, is estimating that we need to build between 430,000 and 480,000 units annually over the next decade. That's double the current pace.
Absolutely, Sandy. It's a daunting task when you think about the numbers. Doubling the pace of construction isn't something you can just decide to do overnight. Aled Yorworth from CMHC mentioned that this would require not just more workers, but also modernization, private investment, less regulation, and fewer delays. It's a tall order, but not impossible.
Right, and this isn't just about putting up more buildings. It's about systemic changes across the board. We need innovation in construction technology and improvements in labor productivity. CMHC is really pushing for everyone, from policymakers to the private sector, to understand the scale of this challenge.
And when you look at the numbers, the need is clear. The Canadian Real Estate Association noted that the benchmark price index for all housing was just under 700,000 Canadian dollars last month, which is down 20% from its 2022 peak. But back in 2019, it was closer to 550,000 Canadian dollars. So, there's a significant gap to bridge.
That's true, Steve. And cities like Toronto are feeling the pressure. CMHC says Toronto will need a 70% increase in home building over the next decade just to address the affordability issues. Even with more rental construction, the region lacks homeownership options that match local incomes.
And it's not just Toronto, Sandy. Vancouver and Montreal are also facing significant housing gaps. Vancouver needs a 29% increase in housing, while Montreal has the largest supply gap of any major metropolitan area in Canada. If we don't address these issues, affordability challenges will only get worse.
Montreal especially has seen home ownership costs rise faster than any other large city since the pandemic when compared to local incomes. Prime Minister Mark Carney has set a target of building up to 500,000 housing units annually, but there are doubts about hitting that target. The Toronto Dominion Bank has even questioned whether the current government can achieve these goals.
It's a fair point, Sandy. The government has introduced policy changes like cutting the goods and services tax on new homes and lowering development charges, but the Toronto Dominion Bank believes these measures won't be enough to close the gap. They suggest it would take an unprecedented boost in productivity, a real revolution in how housing is developed.
The Bank of Canada has decided to hold its overnight lending rate steady at 2.75%, a decision that has left many in the real estate industry waiting for more action. This marks the third consecutive decision without a change in the rate, leaving some industry professionals and consumers disappointed as they were hoping for further cuts to stimulate the market.
That's right, Sandy. The central bank had previously paused its rate cuts in April, and since last year they've already reduced the rate by 225 basis points, which is significant. Still, many were expecting more cuts to help ease financing for housing construction, which is much needed across Canada.
Yes, and the decision comes amidst ongoing economic uncertainty. The Bank of Canada cited high uncertainty and pressures on inflation as reasons for holding the rate steady. They mentioned concerns about higher tariffs from the United States impacting Canadian exports and the potential for these cost increases to affect inflation and consumer spending.
Indeed, Sandy. It's a delicate balancing act for the central bank. they need to consider how these tariffs and trade disruptions might influence business investment and employment. The real estate sector, in particular, is eager for rate cuts to stimulate new housing construction, but the bank seems to be proceeding with caution.
And it's not just the real estate sector feeling the pressure. According to a recent survey by MNP, 2 out of 3 Canadians are desperate for interest rates to go down as inflation is eroding their buying power. With inflation rising to 1.9% in June, many Canadians are feeling financial strain similar to what was experienced during the pandemic.
Absolutely, Sandy. The survey highlights that 64% of Canadians feel they need a rate drop, and 36% are anxious about their financial situation. It shows the significant impact of financial pressures on households, as many feel stuck in a holding pattern, waiting for economic conditions to improve.
Looking ahead, there's some hope among industry executives that the Bank of Canada might consider a rate cut in their next meeting in September. Mark Feeder from Avison Young expressed optimism that a fuller assessment of economic indicators could lead to a cut, potentially energizing sectors like industrial, multifamily, and office real estate.
Yes, there's a sense of cautious optimism. Governor Tiff Macklem noted that while inflation is close to their 2% target, the unpredictability of U.S. tariffs makes it challenging to forecast the Canadian economy. However, there's also a hint that the bank is becoming more comfortable with the idea of needing further rate cuts in the future, depending on upcoming data.
Steve, the Toronto condo market is still in a bit of a tailspin. Sales and prices keep dropping, and it's not looking like there's going to be a turnaround anytime soon. According to the Toronto Regional Real Estate Board, condo sales in the Greater Toronto Area fell by 11% last month compared to the same period in 2024, and prices slid by 4.7%.
That's right, Sandy. And it seems like the situation is even worse outside of Toronto's city center. In the 905 area, sales plummeted by nearly 17% year over year, with average prices dropping 10.4% to about 574,111 Canadian dollars. It's a clear indication that the market's struggling, especially with new builds.
And speaking of new builds, the Building Industry and Land Development Association noted that new condo sales in September were a staggering 90% lower than the 10-year average. Investors are finding these condos to be toxic assets because the demand from renters has dropped, and many owners are losing money since rental income can't keep up with rising mortgage rates.
Indeed, it's a crisis not seen since the 1990s, although there are differences between then and now, as the National Housing Agency points out. The smaller units, especially those between 500 to 650 square feet, are particularly problematic. Mickey Kaneka from DLC Clear Trust mentioned that these units are not desired, and many buyers are scrambling because appraisals are coming in lower than the purchase prices.
Yes, and it's causing a perfect implosion for those who bought these smaller condos, as Kaneka puts it. Renters now have more choices, and with an influx of new inventory expected, it's only going to get tougher. The larger condos are still renting, but the overall rental market is on a decline, which is concerning.
The outlook isn't optimistic, Sandy. With immigration levels expected to be lower and more purpose-built rental supply on the horizon, rental demand for these smaller units isn't likely to bounce back soon. CMHC predicts a turning point before the end of the decade, but that's quite a ways off.
And RBC economist Rachel Battaglia thinks that Canada's new immigration rules might slow population growth, which could further ease rental demand and reshape the housing market. But for now, investors are facing a tough road ahead. As Kanika said, the rates just don't make sense when you factor in mortgage payments, property taxes, and maintenance fees.
Exactly, Sandy. The smaller units are just not an attractive investment right now. It's going to take some time before we see any light at the end of the tunnel. There's still a long way to go before the market rebalances itself.
The Canadian rental market is finally seeing a shift from crisis to cool down, according to a new report from Desjardins. After years of soaring rent prices, we're starting to see some relief, thanks to a surge in new rental supply and a slowdown in population growth. But it's not all smooth sailing, as high construction costs and policy changes could quickly undo these gains.
That's right, Sandy. The report highlights that rent inflation is easing across Canada's largest cities. This is largely due to a record wave of purpose-built rental construction and the federal immigration caps slowing population growth. However, the economists behind the report caution that this relief might be temporary if high building costs and shifting policy slow the pace of new supply.
It's a significant change in the rental market landscape. After decades of limited rental construction, we're now witnessing the biggest boom in a generation. The supply of purpose-built rentals grew by 4.1% in 2024, which is the fastest pace in over 30 years. Montreal is leading the charge, followed by Toronto, Calgary, and Edmonton.
And government incentives have played a crucial role in this surge. The GST and HST rebates for new rental projects, accelerated capital cost allowance, and low-cost CMHC construction loans have helped offset high financing and material costs. But despite these measures, the balance is fragile. Construction costs have risen nearly 20% year over year, and with high land prices and labor shortages, there's still a lot of pressure on builders.
It's interesting to see how federal immigration changes are reshaping demand. With Ottawa's plan to reduce the share of non-permanent residents, the pressure on high-cost markets like Toronto and Vancouver is easing. Desjardins' baseline scenario suggests national rent inflation will continue to drift lower, with Calgary possibly seeing rent deflation and rent growth in Toronto and Vancouver flattening.
However, Quebec might remain an outlier due to its looser rent-setting rules and stronger domestic demand. Even with more supply and less demand, Desjardins warns that the balance is precarious. While borrowing costs have eased, they remain above pre-pandemic levels, which could slow or reverse the rental building momentum if developers find projects unviable.
For renters, this cooldown is a welcome relief after years of strain. It offers some breathing room for homebuyers who have been priced out of ownership, allowing them more time to save. However, it could also soften investor demand for condos purchased as rental properties. The rental market is finally catching its breath, but how long this pause lasts will depend on builders' willingness to keep projects moving and how Ottawa's policies unfold.
It's a delicate situation, Sandy. The rental market's future hinges on many factors, including construction costs, immigration policies, and economic conditions. While there's cautious optimism, the path forward is uncertain. We'll keep an eye on how these developments play out, as they have significant implications for the real estate market and renters alike.
Steve, let's talk about an interesting development in the reverse mortgage market in Canada. Bloom Finance, a fintech company, has announced the launch of the first lifetime fixed-rate reverse mortgage in the country. This is particularly noteworthy because it offers rate stability for life, which is quite a departure from the usual variable or fixed-term rates that typically last up to 5 years.
Absolutely, Sandy. This is a significant move by Bloom Finance. Reverse mortgages are designed for homeowners aged 55 and up, allowing them to access up to 55% of their home's value without affecting their government benefits. The main selling point here is the fixed rate for life, which is currently set at 6.69%. While it's higher than some competitors like Equitable Bank and Home Equity Bank, the promise of rate stability can be quite appealing for those on a fixed income.
Right, Steve. And the CEO of Bloom, Ben McCabe, mentioned that this product aims to alleviate the anxiety that comes with the uncertainty of rate changes. For retirees living on a fixed income, knowing their rate won't change can be a huge relief. It's like buying an insurance policy against rising interest rates, as Jason Heath from Objective Financial Partners put it.
It's a clever strategy, Sandy. By locking in the rate for life, Bloom is targeting homeowners who are planning to stay in their homes long term. However, it's important to note that if homeowners decide to leave early for reasons other than downsizing, moving into assisted living, or passing away, they could face steep penalties. The penalties start at 8% in the first year and decrease over time.
That's a crucial point, Steve. This product isn't for everyone, especially those who might want to move or pay off the loan within a few years. But for those who plan to stay put, it could be a valuable option. And as Jason Heath pointed out, the reverse mortgage market is seeing more competition, which ultimately benefits consumers by providing more choices.
Indeed, Sandy. With more competition, we can expect more innovative products like this to emerge, potentially offering even better terms for consumers. It's a dynamic market, and as more companies enter, it will be interesting to see how they differentiate their offerings to attract customers.
Absolutely, Steve. The reverse mortgage market is evolving, and products like Bloom's Lifetime Fixed Rate Mortgage are pushing the boundaries. It's an exciting time for the industry, and we'll continue to monitor these developments closely. Our last topic for today, Steve, is about a significant appointment at Bridgewater Bank. The bank has recently named Amy Webb as its new Vice President of National Sales, effective November 10th, 2025. Webb is stepping into the role with over 20 years of experience in financial services and residential mortgages. She's tasked with accelerating growth and deepening broker relationships across the country.
That's an impressive move by Bridgewater, Sandy. With the market constantly evolving, having someone like Amy Webb, who has a deep understanding of broker networks and customer needs, is a strategic win. Her role will focus on overseeing the sales, marketing, and product divisions, which are crucial for shaping the bank's national strategy and enhancing both broker and customer experiences.
Absolutely, Steve. The appointment comes at a time when lenders are increasingly focusing on broker partnerships due to shifting market dynamics and customer needs. Dave Fromow, the president of Bridgewater Bank, has expressed confidence in Amy, citing her extensive industry expertise and leadership skills as vital to advancing their strategic goals.
And from Webb's perspective, she's eager to contribute to Bridgewater's next phase of growth. She mentioned that it's an incredible opportunity to work with a talented team and an innovative organization that truly understands the needs of brokers and their clients. It's clear that Bridgewater is positioning itself to adapt and thrive in the current landscape.
It's interesting to see how banks like Bridgewater are seeking leaders with a strong track record in broker engagement and product innovation. Earlier this year, they appointed Russ Mendonca as Vice President of Credit Operations, underscoring their commitment to building a robust leadership team. Bridgewater Bank continues to specialize in residential mortgages and deposit products, with a portfolio exceeding $2.5 billion and over 40,000 accounts across Canada.
With such a substantial portfolio, their focus on innovation and broker relationships is crucial. As a Calgary-based Canadian Schedule I chartered bank and a wholly owned subsidiary of the Alberta Motor Association, Bridgewater Bank is well positioned to leverage these strengths. It'll be fascinating to see how Amy Webb's leadership influences their growth trajectory.
Indeed, Steve. The mortgage industry is always evolving, and having experienced leaders at the helm can make a significant difference. We'll be watching closely to see how Bridgewater Bank navigates the challenges and opportunities in the coming months.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals.